You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan defined risk mutual funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it's time once again for the Advisor's Option, the program here on the old Options Insider Radio Network, where we break down the intricate and amazing and sometimes deep and in-depth and sometimes even overwhelming to newcomers world of options. We break it down for you, the busy financial advisor and asset manager who wants to learn how you can incorporate these tools into your clients' portfolios. My name is Mark Longo from the aforementioned Options Insider Radio Network, as well as, of course, from the ever-exciting OptionsInsider.com. And, of course, if you like this show, I encourage you to branch out a little bit. We have 15 programs on our full network. The easiest place to check them all out, of course, is to go to your audio provider of choice. Could be iTunes or TuneIn or Stitcher or even our website, theoptionsinsider.com. It's all available there. And then just subscribe to our main network feed. That'll get you all 15 shows, so our daily news show, our popular option block and volatility views program, this program obviously as well, our tech show, a lot of shows in there. This Week in Futures Options, all sorts of fun content. If you're interested in options-oriented content, I'm guessing you are if you're listening to this, then don't worry. We've got you covered. Of course, you can always get it as well via our mobile app, available for all of the major app stores. And however you listen after the fact or whatever platform you use to listen to the show, make sure you hit us up with those questions, those comments. We do love to hear from you guys. And joining me on the old program today, we got a great cast of characters joining me for the Advisor's Option today. Starting off with our dynamic duo beaming in from the tropical headquarters of Swan Global Investments. They are Chris Hausman, the Portfolio and Chief Technical Strategist, and Aash, the Director of Portfolio Strategy and Overlays, both beaming to us from the Swan HQ in Puerto Rico. Gentlemen, welcome back to the Advisor's Option. How are things down there in lovely and tropical Puerto Rico?
Hey, Mark, good to be back on again. I think it's still pretty sunny. Not much changes on that front.
I think that's pretty much the weather report. 360, maybe 363. Maybe you get like 2 or 3 days of clouds down there, right?
That and the occasional eclipse, but good to be aboard, Mark.
Yes, eclipses aside. So 364 days of nonstop sun down there in scenic and sunny Puerto Rico. Also joining us is a newcomer to the show. He's been on a few times now, but now he's holding down a regular co-host seat. We're very happy to have him. Mr. Matt Amberson from Orass.com, beaming to us from a little bit perhaps less sunny part of the world, scenic and sunny New Hampshire. Certainly less sunny later on in the year. Right now, though, pretty beautiful. Matt, welcome back to the show. How are things in scenic and sunny New Hampshire?
It's always tropical up here, Mark, and especially during the Advisors Option Show. Thanks.
There you go. Always tropical in New Hampshire. You sound like one of my other cohorts on the network who sings the praises of Maine. Now you too can join him in singing the praises of northern New England for our listeners. And also joining us on the program today, we have a special guest host joining us for the first time. She is Carolyn Leonard, the co-founder of DyMynd. Carolyn, welcome to the Advisors Option program.
Thank you, Mark. I'm excited to be here today.
And Carolyn, as we are wont to do with all of our first-timers here on the network, why don't you go ahead and fill our listeners in with a little bit of an overview. Obviously, you've been around in the option space for quite some time. Fill us in, give us a little bit of overview of your background in the options market and how you found your way to co-founding DyMynd.
Well, Mark, I have been around an awfully long time in the options market. I came down to the CBOE floor in 1976 to become an options trader. It was a time at which it was basically very much a boys' club, a man's world. And in fact, it took me 3 months to go through all the SEC approvals and to pass my tests and to become a member of the Options Exchange, and I bought a seat and I started trading. And I did not receive a warm welcome at that time from my fellow traders. It was quite challenging to begin with, but we worked it all out, and I wound up trading for 21 years. It was one of the best careers that I think a woman can have. I think the total financial services industry is an awesome place for women. And I learned an awful lot about options trading and the value of options trading, and I use it to this day in my investments and in my portfolio. But it was in 2008 when the market imploded, and I have a large group of very successful female business owners and corporate leaders, and most of these women had been incredibly good savers and good investors, but their portfolios took a big hit, as everyone's did in 2008 and 9, and they began calling me up and saying, can I come over and talk to you? I really am concerned, and I don't know what to do. And these were women that I would have thought had the best financial advisors in the world because of the fact that they had large assets. And in fact, I came to learn that most of these women, when they came over, had multiple accounts because they hadn't found an advisor that really understood them and that they felt really comfortable and had a high degree of trust with. So when I realized that these women were having a hard time finding the right financial advisor, it occurred to me that I bet most women are having the same problem. And DyMynd came out of that. DyMynd is spelled DyMynd, and it's for Dynamic Minds. And we started out looking at the female client from the point of view of the emotions surrounding money, and that I knew from the way they felt during the market crash that they were deeply impacted and extremely fearful. Many of them felt that they had worked all these years and they were going to lose everything they had. They feared becoming homeless. I mean, their fears and their emotions around money were palpable. And I looked at that, and I know when people have extreme emotions and fears, there's opportunity, because on the trading floor, the more volatility and fear, the greater the opportunity. So we launched DyMynd, and DyMynd looks at a woman through three lenses. One, we understood from all the research we did. We talked to hundreds of women, and we taped the conversations, and the overwhelming themes were ones that women carry past, present, and future with them at all times. And although they are doing very well today, they always worry about, are they going to be okay in the future? And because of the fear of, are they going to be okay in the future or outlive their money, the second factor they carry is the bag lady syndrome, and they overwhelmingly fear outliving their money. And so as a result of how they look at money and how they think about money, we knew that we had an opportunity to help the industry and to look at the female client differently than their male clients. And there's a great quote by Les Wexner from Limited, who said, "You can't sell to a woman like she's a man wearing. You can't sell to a woman like she's a man in a skirt." And we firmly believe that, and that the model that'll work for a woman is very different, because we have to take into account the way she views things through her lens and the way she feels about money. Women will bankrupt themselves for their children. So she comes at money very differently than men, and it's not just a cold, hard fact for her. So that's what DyMynd, how DyMynd came about.
Well, thank you for that rundown there, Carolyn. I think with that intro, it's a perfect setup for our top topic here in The Buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get The Buzz.
All right, everybody, welcome to The Buzz. Like the man said, this is the portion of the show where we break down some of the hot developments, interesting events, upcoming events maybe, that are interesting, I think, to you, the busy advisor, who's quite frankly busy running his practice, dealing with his clients, doesn't have time to keep up on all the latest developments in the world of options. So guess what? We do it for you. And we're kicking things off. The reason Carolyn is joining us today is because her firm, DyMynd, partnering over there with our friends over there at Box, the Boston Options Exchange, as well as IMCA, they of all the credits, the keepers of the credits over there, to produce an interesting event. It's kind of combining a couple of different niches here in one space. We talk a lot here on this program, obviously, about bringing advisors into the option fold. It is the name of the show, after all. It's kind of the mission of this program, is kind of expanding the reach, the gospel, if you will, of options to a lot of different players. And now Carolyn's looking to take that approach and also apply it to a new segment that she was just alluding to, the female segment. They're calling this seminar, I like the name, Carolyn, by the way, All Women Want Options. This is to provide financial advisors with the tools to incorporate option strategies into their clients' portfolios, covering income generation, a topic we talk about a lot, as well as protection. Also provides financial advisors with the tools to build lasting relationships with their female clients by sharing insight into how women look at money and investing. Carolyn, you kind of just gave us an overview of what prompted the creation of DyMynd, but obviously your background at the CBOE makes you uniquely situated to look at the female perspective on options. Did you look at the space and realize, hey, these women, as you mentioned, had a lot of different advisors, a lot of different accounts. Did you realize that there was literally just no penetration for options? So this was a perfect opportunity. What was the genesis of this webinar, and what specifics are you going to cover there?
Well, what I understood from all the women I talked to and the women we had in our roundtable discussions is that they had zero option strategy in their portfolio, and yet most of these women held an awful lot of corporate stock. Some of the women that were working with law firms that came through our roundtable discussions had a more diverse portfolio, but they, like the other women that were corporate, had absolutely zero option strategies. And as I began to talk to these women about options and option strategies, they kept on saying to me, well, our advisor tells me it's much too risky for me. And I beg to differ with that. I talked to them about the fact that there's income generation, as you know, and that since they're not thinking today of selling any of their stock in the companies they work for, why wouldn't they want to sell calls, out-of-the-money calls, against those positions? And a lot of the women agreed with me. Why wouldn't they want to do that? And so I encouraged them to talk to their financial advisors and to, in fact, begin instituting a program about covered call writing. And the women that prevailed and did it are really very happy. And what's really interesting about it, the fact that they are doing covered call writings gives the advisor the opportunity to have more touches and a different conversation with her. And it's a win-win on both sides. And the women that are doing the covered call writings are thrilled. They're excited. They call me up and they tell me, I just rolled over a group of options, and they are watching their investments on a different level because options have given them something that is really interesting. It's smart. It's cool, and they feel that they have an edge in the market. And a lot of the women that are now we're doing the covered call writing are beginning to understand the power of puts in portfolio protection. And what's really interesting in talking to women is that they will tell me that, well, of course, I don't have a problem buying protection or insurance. I buy flood insurance. I never want to have a flood, but I look at the puts I'm buying when I have sleepless nights as my flood insurance for my portfolio. So, taking the voices of these women and the impact we know that trading options can have in a positive way on a portfolio, we decided to expand it, and we went and we've got 3 CU credits for our seminar on September 19th here in Chicago, and we're really, really excited to roll this out into the market.
I think I called it a webinar, but it's an in-person seminar, correct?
Yes, it is. It is.
So unfortunately, you can't beam in, but is it going to be in Chicago? Where's it going to be?
It's going to be in Chicago, and it's in the Bank of America building, and it's 135 South LaSalle, and it's on September 19th. It's from 8 in the morning to 12 noon. And if anybody wants to sign up, we have an early bird promotion, and it is capital S, capital T, capital A, capital C, stack. And you will get 20% off as an early bird.
Chris, I believe you had a question for Carolyn.
Yeah, hi, Carolyn. I was just wondering, what were some of the challenges, or what do you think was the biggest challenge to try to get people to understand options better and to incorporate them in their portfolios?
Well, I think the biggest challenge is helping them understand that options are not a weapon of mass destruction, and that we assume risk in many aspects of our investment, and yet we don't have the same feelings about it. And I think that a lot of the fears or reluctance to trade options and the obstacles for the investor is they feel they just don't understand it well enough. And because they feel they don't understand it well enough, they're reluctant to even try. And so in talking to different people, I've said, it doesn't hurt. Just buy one. Just get one option and watch how it works, because I'm a firm believer that in order to understand and learn, I'm a kinesthetic learner. I learn by doing. So I know that if I own something, an option or a stock, I'm watching it much more differently than if I am paper trading. So, it's like you're not going to get hurt buying one call. See how they work, see what happens, and stick your toe in the water. You're not going to get hurt if you have General Electric stock by selling an out-of-the-money call against it, and see how that works. And so it's a matter of helping them understand that you will gain experience. I call it an out-of-pocket education. When I take money out of my pocket and invest it in something, I learn differently. And so it's that out-of-pocket education and that direct involvement in the market that I think is really valuable to overcome the obstacles.
Carolyn, this is Matt. This is music to my ears. And first of all, we haven't met, so I wanted to say hi. We were on the CBOE at the same time. I got down there in 93 and left about 2002. And I back traders on the floor. And now I have a research firm. We do a lot of back testing. But I'm really enjoying what you're saying. I was actually thinking about the analogy that you made to flood insurance earlier, and even life insurance and right. All the types of insurance that we get. I think a better way to look at risk in some ways is what I call debacle risk.
Yes.
And if you don't have the type of protection on, you're not protecting yourself from a debacle. I mean, we have Sharpe ratios and all that, but I think a better way to think about it is, what's your return on your biggest risk that you could have? And if you look at it that way, I think that more people would be interested in protecting, downside. And and if you're not going to sell, you could sell an out of the money call, or if you would sell at a certain price, of course, sell it out of the money call. So I just wanted to say to you, I wish everyone had the sense that it sounds like the people that you're dealing with have. I've been, putting back tests together for tail risk and covered call selling for many years now, and it's difficult to get people to step up. But we learned through the Cirilli study that advisors that have options in their personal portfolio are much more likely to then recommend them. And one of the things that I do with my programmers and even the programmers when I was trading on the floor was I put them on a badge, or even the programs that we have here at ORATS now, we trade. And so they know what's going on. And you do think about things a lot more clearer, and if you have a position on. So I don't really have a question for you, but I think what your comments are just great, and I'd like to applaud you for that.
Well, thank you. And, and it's really interesting because many of the women that we talk to and we encourage to ask their advisors to get them in an options program have to overcome their the advisor's reluctance to put them in options. And in fact, one of my girlfriends came over and she had like a 4-page document, and she said, "Do I need to talk to a tax lawyer before I sign this?" Because it was Merrill Lynch's form if you were going to trade options. And it was like even that form was another barrier, and it was intimidating. And, and I really think that, and I understand why firms do it, but I think that it's just a way to keep people out of trading options, and understanding that they really are necessary to your long-term goals. And when women understand, because the difference between the male and female investor is that she steps out of the job market to take care of children, many times to take care of parents, and she outlives her partner statistically. So women really have to take more risk, and women have to be willing to step up to the plate and look at alternative strategies. And I just think that the additional income generated by options for a woman is just a necessity to her portfolio.
Carolyn, you mentioned some of the emotional challenges out there when talking about options with women. What are some of the other challenges that maybe make this options audience unique? Like you mentioned, your friend who brought you the documentation. Clearly a lot of them haven't really been exposed to this before. So what are some of the other unique challenges you can think of when you're sitting down with a room full of women and discussing with them covered calls or protective puts for the first time?
First of all, a lot of them are like, "Why didn't anybody tell me this before?" What do you mean if I was? I mean, they're like, it's really interesting because it's a very visceral reaction to the fact that I'm a smart girl. I can learn this. What is the dirty little secret that nobody is talking to me about this? And why isn't my advisor putting me in this? And yes, I've had sleepless nights, and had I known that I could have bought a put and protected some of the stock I was worried about, I would have done that. And so it's really interesting because women really feel that, because women feel to begin with that financial advisors really don't get them, that they feel that women are asking too many questions, and that lots of times because she's very, very hesitant to pull the trigger on things, it's because she doesn't understand, and that clearly isn't the case of her not understanding. Many times it has to do with something that we call a care network, and that a care network are all those people that women are thinking about when they're thinking about their investments and money. And many women's lives it's an extended family that they're caring for. So in their head, when they go see a financial advisor, he basically looks at them and thinks it's her and her 2 kids and her husband. And in her case, it may be her 2 kids and her husband and her parents. So lots of times, because women are carrying this larger care network, they are more thoughtful before they pull the trigger. But once they understand, they are willing to stand toe-to-toe with any man and take as much risk on as a man would when it's reasonable and they understand it.
And it sounds like you're focusing on the woman directly, so you're kind of going from the client side and educating the clients who will then turn around and bring this information, in fact, bring their quote-unquote demand for options to their financial advisor. What, in your experience, has been the response to that when the clients show up knocking on the door of their advisor and say, hey, I want to start writing covered calls, or they want to start buying puts? We talk a lot on this show, and that's kind of been the focus of the show for multiple years now, is trying to get the word out to advisors about options. We've talked about a lot of data, a lot of studies from our friends at OIC about this effect, but what has been your anecdotal view of this, talking to the people who attend your seminars and your clients? What has been the response to the advisors when they go out there and start asking for these techniques? Are they receptive? Are they a little bit fearful? What's the response?
Well, actually, most women find that the advisors are not encouraging them. And I believe that the reason the advisors aren't encouraging them, and that's why we launched All Women Want Options, is because they don't understand. And we know nobody wants to appear dumb or uninformed. So most of the women have to convince the advisor that this is something that they have to do, and it would be a deal breaker for them, because they now understand the value in having options in their portfolio, and they clearly want them. And at that point, the advisors then begin to start the paperwork, and we'll help them and we'll instigate an options program for them. But the women that we've talked to that are doing options trading against their portfolio have had to ask. It was not recommended. And that's one of the big things that I want to change, is that advisors have got to start recommending and have to get the education themselves personally, so that they're comfortable making these recommendations to their female clients, because it works in her best interest. And working in her best interest is in his best interest, because a female will recommend a good advisor 26 times as opposed to a man who only will recommend his advisor 11. So you've got her working for you if you are helping her in her option strategies.
Well, Carolyn, I'm glad we can come on and give us a little bit of some information on your seminar and your event. You've been brave enough to volunteer to stay on with us for the entirety of the show. We'll see if you come to regret that by the end of the show or not. But before we end this conversation, I want you to remind our listeners again, if they're interested in attending this seminar, where should they go? What should they do?
If you go to Eventbrite or DyMynd.com, and that's DyMynd.com, and you can get All Women Want Options. On DyMynd's site, you just click DyMynd U, like Dymond University, and on Eventbrite, just write All Women Want Options September, and it will come up, and I would love to see you there.
There you go. Check it out. Meet Carolyn in person and see what all the fuss is about when you're talking about bringing options to an interesting new audience, one that we haven't really talked about much here on the program before. It's been hard enough just to get advisors into the fold. Now we're talking about bringing women into the fold. It's an entirely new challenge, and it sounds like Carolyn is up to the task. Moving on here with the buzz, a lot of other stories are really top of mind for a lot of our audience out there in the advisor space as well, including the ongoing kerfuffle, brouhaha, debacle, call it what you will, that is the DOL battle. Longtime listeners of the show know this was a big issue for the option space about a little over a year ago, when they threatened to effectively, with the early incarnations of have this bill to effectively ban the use of options from IRA accounts. That was a big deal, as you might imagine, for the option space and the entire industry, including a lot of our leadership from our friends over there at OIC. Really spent a lot of time lobbying and educating Congress and the Department of Labor about the issues with that. It seems like that issue hasn't really reared its ugly head again, but people are still concerned. People keep asking us about an update on this. And the latest update, we mentioned last time on the show that multiple committees were trying to fight and potentially kill this things from multiple different vectors of attack. Now we have the DOL itself seeking what amounts to an 18-month delay for compliance. So everyone who is worried about this upcoming January deadline really being difficult to meet, particularly with so many of the terms of the new iteration of the rule still up in the air, that date for fiduciary compliance potentially going to be extended by 18 months, as you might imagine. Approval. People who are fans of the DOL rule out there really not a fan of this. They want the rule to be enacted pretty quickly, whereas those who are opposed to it are pretty happy. That gives them more time to really get their ducks in a row and see what's going on. So for the latest, for the time being, at least, it appears to be there is a delay for the DOL. We'll stay on top of it. If there's new developments coming on, stay tuned to the network, stay tuned to our website, and of course, stay tuned to the next episode of The Advisor's Option. This is an ongoing battle, and it sounds like it won't be settled for the next 12 to 18 months. So stay tuned for more DOL. Looks like the good news is they haven't really endangered options yet again, but we never know with different incarnations of this bill. Moving on to an interesting new report coming out of the Investment Advisor Association. They broke down what they term the typical. Now, this is the SEC registered investment advisor. Some breakdowns of the typical advisor in that space. They included a very interesting infographic. We'll include it in the show notes. You can see it yourselves, listeners. But some interesting key takeaways from this report. Most of these clients, most of these advisors, their clients are individuals, likely to have at least one pension or profit sharing plan as a client. They typically average $333 million in regulatory assets under management. That's pretty sizable. I was not expecting that number. Again, these are SEC registered investment advisors, so perhaps a little bit larger pool to draw from there. They typically have 9 employees as well, and 26 to 100 clients managing about 108 accounts. They exercise discretionary authority over their accounts, but don't have actual physical custody of the assets or securities in most cases. A few other interesting takeaways. The number of actually federally registered advisors has increased slightly, almost 3% since the 2016 report. It's now 12,172. Again, this is focused domestically here. So strong job growth there. Still, a lot of them are still, like we mentioned, small businesses, only have an average of about 9 employees. So managing a sizable amount of assets with a pretty small number of employees is also pretty interesting. The total AUM managed by these advisors remains pretty substantial. If you add it all up, 70.7 trillion. So that's a lot of assets being influenced by these advisors. The number of clients relatively flat, about 35.6 million clients added together. So pretty much unched from this time last year. Again, individuals, the largest segment of clients, but pension plans coming in, starting to factor more. We talked a lot about how we can bring more funds and pension plans into the options fold. That seems like it's a growing issue for the entire advisor space, bringing more of those plans into the space. And most of them also focus their services on one category of clients. So usually individuals in this case, some others go after funds and others. So interesting nuggets. I encourage you to check out the show notes. You can see that infographic, at least for yourselves, listeners, and check it out. Matt, I know this report kind of resonated with you. What were your thoughts on some of these interesting and perhaps surprising takeaways on the quote unquote typical investment advisor?
Yeah, it was a good report. It reminds me of the Cirilli report in a couple of different ways, but there's always kind of an eye-opening thing that I noticed, and I wanted to go first. So maybe Aash or Chris could help me understand a couple of things. But a couple of the shocking things to me were how many advised pensions. So there must be a lot of pensions out there. Must be smaller pensions or maybe even just corporate pensions. I don't know if Chris or Aash could help me with understand that. But another thing that I thought was that most advisors, or not most, but 60% are not engaged in another business, but 40% are. And the 40% mostly were commodity pool operators or trading advisors. So again, I wonder if Chris or Aash know anything about, would that pose a conflict, or is that pretty typical? I mean, obviously 40% of them are going that way. So I don't know. Does anyone have any color on that?
Aash, that sounds like that's right up your alley, sir. What are your thoughts on this study as well, and maybe some interesting takeaways there, as well as Matt's interesting point there about potentially a bit of a conflict there between managing what effectively is an RIA as well as perhaps a commodity trading pool?
Yeah, well, I would tend to agree with Matt that every case is unique, but I would think there's a significant potential for a conflict of interest given that breakdown.
Yeah, it certainly seems that way. I'm glad you pointed that out, Matt, because there were so many data points here that one kind of slipped by me. That's why I like having you guys on there to pick up the ones we miss here. But interesting stuff here, nonetheless. Chris, any thoughts here about this survey, and perhaps maybe you have an answer for Matt's question?
Well, I just wanted to ask Matt, I mean, through his client base and all the back testing that he's done over the years, has he noticed a shift in the makeup of the clients? I would imagine at first you had more ex-market makers like us coming from the floor who shifted to liquidity providers to now the pension funds and maybe other organizations, where there's been a shift over the last few years in the type of client or person that's looking to back test and incorporate more options in their portfolio, for protection on the downside or income generation.
Yeah, you just told our story, Chris. Coming off the floor, we saw a lot of trading firms that needed to continued to compete with dual listing, and they didn't really have the research, so we were selling a lot to those types of firms. And as those have gone down pretty dramatically, we're getting some big pensions coming in now, looking for back testing. We're getting quite a few, what I call options as a second language, long, short, and people that are very strong statistically, but may not know options as well as you guys certainly, but as well as they know other facets of the financial spectrum. And so we're finding ourselves educating through back testing, through our research, and providing the quants, the big data, and so yeah, I mean our clientele has kind of mirrored what's going on in, this study. We're getting more registered investment advisors, more pensions, and that's the way that we're seeing the market moving towards. Thanks.
Carolyn, I know this is a lot of data to digest here, but you obviously are pretty active with the advisor space. You interact with a lot of them anecdotally and talk to a lot of your clients about them. Any surprises for you in terms of the data coming out of this report about what they term the quote-unquote typical registered investment advisor here in 2017?
No, I was very surprised to see how much the typical advisor, how much money he has under management. I mean, I think it's very impressive. I'm also surprised that they have pension funds. I would not have expected that.
Yeah, that number jumped out at me as well. I want to dig into that a little bit more to see exactly, maybe there's a subcategory of advisors we're looking at here, because I certainly know quite a few advisors who don't tally up to 333 million. So that number is probably the one that leapt off the page to me the most as well. So I want to dig in a little bit more, but at least from their key takeaways and looking here, that does seem to be what their number they're putting out there. So interesting and perhaps a little bit surprising there as well. A lot of asset managers doing a little bit better perhaps than we had thought out there. Moving on to another big topic of conversation in the general advisor space. People have talked a lot about, robots encroaching and some of the fear there in the wealth management side. We've often talked on this show that options and using those types of high touch type strategies are a great counterpoint to that, because you're providing a level of service and indeed a level of expertise that the computers, at least currently, can't match. So if you want to be the advisor who stands up against the quote-unquote robo-advisors and pushes back and retains and perhaps even grows your practice in the face of that, then understanding options, having a little bit of that expertise, as we were saying earlier, to generate income, to protect your clients' portfolios. These are all great, very desirable skills to have. Now we're seeing some continued worry, continued talk about that. Everyone knows the big acquisition of recent months has been, of course, the Amazon acquisition of Whole Foods, and this has spawned a almost cottage industry of speculation about where will Amazon go next? What will they buy next? Which industry will they quote unquote disrupt next? And a lot of the talk seems to be settling now around potentially the next area of opportunity. The next victim, call it what you will, is indeed the wealth management space. Others have also mentioned Google coming into that space, and this is a concern we've heard a lot on our tech show as well. That people talk about, the focused players in the space. They sometimes miss the big picture of some of the larger potential leviathans that are lurking out there and may not be aware of the opportunities in this space yet, but they're starting to wake up to this fact. Amazon has already partnered with UBS and some other firms to do some simple financial advising through the Alexa device. So maybe that's a gateway drug for a lot of the listeners out there. You can ask Alexa maybe which put strike should you look at when you're buying your protective put. But this kind of raises some interesting conversations. Obviously, Amazon, the backbone for a lot of the technology we know out there on the internet. So for them, maybe coming into what is a very highly regulated space, maybe a little bit of a deal breaker for them. So it's kind of interesting. Also, Amazon, kind of a big, kind of almost generic, anonymous web entity. People like to build relationships. As Carolyn was saying earlier, people like to come in and develop that emotional rapport with your advisor. Can you really do that with this anonymous cloud-based entity? I don't know. It's an interesting question. One that certainly I think is a lot of people are debating right now, particularly post Whole Foods acquisition. Matt, I know you've been on our tech show before. You're pretty active on that side of the fence as well, with all the things you guys do over there at ORATS. This has kind of been an interesting, lingering debate for a while, but now it seems to be gathering steam again. What are your thoughts specifically about Amazon, but also maybe Google and some of the other big leviathans out there who run a lot of the internet now, and potentially their ability to dive into and perhaps disrupt this space?
Yeah, especially the millennials are more apt to get their advice this way. That was at the Options Industry Conference. They had that panel that we referred to before, and also in the report that we were just talking about, they mentioned the robo advisors and they had experienced growth, but there were some miscounting. I thought they had some interesting points in there, and also just a quick point on those big numbers that we were seeing, the 333 million. Those are regulatory assets. Those aren't regular assets. So what the report said is that there could be some double counting, and I'm sure there is quite a bit of double counting. For example, when they're saying how many assets that we manage, another investment advisor might be managing those same assets. So I think there's a lot of double counting there. It's sometimes difficult to know exactly how much you're actually managing. So I think that is why those numbers seem inflated. As far as Amazon, and Alexa always listening to you and watching you. I have a little aside here. If you ask Alexa, are you involved with the CIA? Alexa goes quiet. So I don't know if I'm going to trust my investment monies to Alexa.
Spoken like a man who lives in the live free or die state. I like it.
Yeah, that's a good New Hampshire comment.
Good, well done. But you're right. I kind of thought when I saw that number coming out, going back to the earlier poll, it seemed like there had to be something else going on with that number. So it might be that. I noticed I hit on the regulatory issue as well. So there sometimes is, you're right, a little bit of double counting there, which is perhaps to blame for such a lofty number out there. For a lot of advisors would kill for that amount of AUM. So interesting stuff there. Speaking of interesting stuff, you guys always send us in so many interesting. We probably could fill a whole show with the questions, but we want to make sure we get at least a few of you on the show this week. So without further ado, let's keep on rolling right on into the office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours. Like the man said, this is the portion of the show where we take your questions, your comments, your insights, and we break them down here and try to answer them, as many as we can here on the old program. Let's kick it off, paying off a question we asked you guys on the last show. At the time, about a month ago, we were seeing VIX hitting pretty much new lows, S&P hitting new highs. So we asked you guys, in this environment, what is your advisor telling you about using options? We gave you 4 choices. We said, are they telling you to write covered calls? Are they telling you to buy protective puts? Are they telling you to do both, aka to use collars? Or they just won't touch options completely? And 35% of you coming out and saying they want you to buy protective puts. So interesting. But that, unfortunately, maybe even more, not surprising, but maybe more interesting, the number 2 choice with 30% was they're still telling you not to touch options whatsoever. So that number is still showing us that Carolyn and the rest of us still have some work to do in spreading the gospel of options to a lot of the advisors out there. 22% saying do both using collars. So a good number there. Again, we speak to a little bit more option savvy audience. So we'd assume they would choose a more option-savvy advisor, as well as, of course, a lot of the advisors in our audience as well tend to be a little bit more option-savvy. So speaking to a little bit, preaching to a little bit of the choir there, but still interesting, 13%, only 13% coming in at the end saying writing covered calls. I thought that would do a little bit better. So interesting stuff. Interesting to see what advice you guys are getting and how they view options right now. Let's move on to a question here from Tancray. He, or perhaps she, wants to know, do you think the trend toward passive investing will help or hurt options-focused advisors? You know, Chris and Aash, maybe we'll start with you. I know you guys over there at Swan have talked about this topic a lot at some of your 10th box events and other things like this. I think there's a general, quote-unquote, conventional wisdom that options are in the active camp and that you can't really be passive and use options at the same time, and so therefore it may hurt the options-oriented advisor out there. But you guys have been talking about this for a while. What are your thoughts over there at Swan about this trend toward passive and how it may impact the advisor using option, or the option using advisor, easy for me to say, going forward?
Well, we definitely notice a trend from active towards passive, but we're really talking about the equity space. So it doesn't negate the need for having insurance, i.e. downside protection, or trying to add incremental income to your portfolio. So options are not going to become passive vehicles. I mean, they do expire. There is a lot more, there are more inputs that we have to deal with as opposed to your garden variety equity ETF. So no, I think options have a huge place in passive portfolios. I mean, there's still going to be the need to, like Carolyn said earlier, is to avoid a 2008 and also, in these low yield environments. Well, how do I make more money? Well, options is a great place to do that. So it takes more education, getting people used to the fact that they should be implemented in a portfolio, and whether the equity component is passive or active is a different question. But I think options definitely have a space in either camp.
Yeah, you're right. That term passive, I think it's a bit of a misnomer. People hear that and think, I literally have to do nothing. I just buy an index and ride it up and ride it down. And certainly for a lot of those people, that is the case. But you can still use options and be fairly active. Even if you are invested in a quote-unquote passive index, you can still buy puts to hedge it. You can still write calls to generate income off it. In fact, we encourage you to do just that. So the notion that you're in maybe a passive underlying doesn't mean you have to be passive itself. Carolyn, same question for you. You're obviously out there talking to a lot of people who are utilizing advisors, and indeed the advisors themselves. Have any people asked you a similar question about this? Why do I need options when passive indexes are doing so well? And what are your responses to them if they have?
Well, my response is always that it never hurts to pick up some extra money, and that I'm always telling individuals that I think if you're going to hold your stock and you're not a seller, then you've got to become a covered call writer. And I think that that works. I mean, and I think that a lot of people would like to think And I think they're deluding themselves that they can justify passively. The past has showed us that we cannot, that volatility does raise its head, and that you have to be prepared and you have to know what action you want to take.
Matt, same question for you, sir. You're the man with the data. You're the man with the back test. You can probably sit down with someone and say, here's the holding the S&P over X period. Here's writing a covered call and a protective put and collars and that sort of thing. So what do you normally say to people when they approach you with? Is that your response? You show them the data?
Yeah, I mean, the first thing is I've been happy to see more people saying how much risk there really is in just being a passive investor. Again, I beat the drum for, how much return are you actually getting on the debacle that you're not protecting yourself? As Carolyn said, the flood insurance for your portfolio, you're taking on an immense amount of risk. And then, after 2008, 2009, then they all start to run around and say, oh, I didn't even know about puts, that could protect me. So I and you and Aash and everyone has been out there saying, listen, you have to really look at the downside. And, these drawdowns can last 10 and 20 years. If you look at, there's a great video on YouTube, 180 years of drawdowns by one of the old Renaissance partners. And I think it's very telling that, these market corrections, crashes occur, and it's going to take you years to get back to where you were before they happened, unless you have some puts. And yeah, we're doing a lot of back testing for individuals all the way to the largest pension funds on how to, minimize the cost, but maximize the effect. And what do you want to have happen? I mean, in a flood insurance, you don't want to pay for a lost umbrella, but you want to pay in case your house floats away. So that's, you have to know what you're protecting. How far down. You might not protect down 5%, but you definitely would want to protect if the market goes down 40 or 50%. So what we show them is, listen, you can protect these types of market corrections that will occur for not an exorbitant amount of money, and you could cover part of it. I mean, I think it's it's not necessarily comparing apples to apples, trying to use the income from covered call writing for tail protection. We like to look at those separately, but it is a way to have it not hurt as much when you are paying a little bit for this tail protection. So we're testing. We're trying to find the best ways, most cost-effective ways. And what happens in these varying market corrections that you really should be protecting yourself for, Mark.
Spoken like the man with the data. Well, we have so many questions here, so many different themes you guys want to talk about. Let's see if we can mix it up a little bit. We were talking about robo-advisors and the encroachment of Amazon earlier. We got a question about that here from Nick. This comes, by the way, good question before Tancray. That may be a good subject for a future show. I'll keep that in the back of my mind for a future show. Using options as a quote-unquote passive investor. There's a lot to talk about there. All right, this question comes from Nick Sacella. He says, I've read a lot about robo-advisors encroaching on the domain of the traditional financial advisor. I would think complicated assets like options, wouldn't be well suited to algorithms and machines. Is it fair to say that options then are the silver bullet to the rise of the robo-advisor? Well, I mentioned this, I alluded to this earlier in the show. We have said that on the show before, maybe not the silver bullet per se, but it is an excellent response to a lot of these, quote-unquote wirehouse guys are the ones who are kind of falling under the oncoming tread of the robo-advisor tank, because a lot of these guys aren't offering much more than you walk into their office. They ask you how old you are. They ask you some vague risk tolerance, dynamic, whatever that might be, number 1 to 10, something like that. Then they put you in a spreadsheet and it says pretty much 60, 30, 10 equities, fixed income, and maybe if they're aggressive, a little 10% for, gold, something like that. That's pretty much the lion's share of what they do. And if you're that guy, that's all the service you're offering. Yeah, you're in trouble, which is why we've said options can provide a great counterpoint to that. Aash, I know this has been a big talking point for you in recent past. Maybe you have some interesting dubious correlations on this. I don't know, but you always have a good chart or two in your back pocket. But what are your thoughts here for our friend Nick, who wants to know, are options, are they the silver bullets to the werewolf of the robo-advisor?
I'm not sure if I'd go as far as silver bullets, but as you mentioned, they're very useful simply because, on some of the things we've touched earlier, it doesn't matter if your strategy is active, doesn't matter if it's passive, you can have success either way, but neither active or passive addresses the fact that you really can't diversify away risk. You have to hedge it. And, to that extent, a lot of these robo portfolios, it's foolish to ignore advances in technology. But if it's a one-size-fits-all solution, that means everyone has the same portfolio. That means when everyone wants to get out at the same time, usually that results in a crash. So some sort of hedge component, to your portfolio, which options are very useful for, seems to make a lot of sense if you think it through.
Carolyn, as our guest, will give you the last word on this question. And unfortunately, I think the last question we have time for here in the office hours this week. What are your thoughts? Again, you're interacting with a lot of clients and their advisors these days. What are your thoughts on the notion that options are a great counterpoint to the robo-advisors coming in and eating your lunch as an advisor?
Well, I think any advisor that can have more touches with his client and build trust doesn't have to worry about robo-advisors. It's the guy that has a very mechanical and a very much cookie-cutter approach to his clients that's going to, whether it's robo-advisors or it's a more personable or more aggressive advisor, he's going to have somebody eating his lunch because he really isn't serving his client.
All right, listeners, that music means we've come to the end. Hard to believe it's been an hour already. Hour flies by when we're talking options and advisor. But unfortunately, that's all the time we have on this episode of The Advisor's Option. But before we go, I want to go back around the horn and check in with all of my cohorts here on the Advisor's Option panel today, see what they have cooking up their sleeves that may be of interest to you, the busy advisor, and indeed their clients. Carolyn, as our guest, we'll start with you. You mentioned your upcoming seminar here in Chicago. Why don't you go ahead and run down those details again for our audience, as well as if our listeners are interested in learning more about what you do at DyMynd, what can they do for that as well?
Thank you very much, Mark, and thank you for having me today. I've really enjoyed the conversation. DyMynd is launching on the 19th of September, All Women Want Options, and boy, do we know that's true. We're hosting that at 135 South LaSalle in the Bank of America building from 8 until noon. You'll get 3 CU credits, and you can register for it on Eventbrite for September 19th, All Women Want Options, or you can go to DyMynd, DyMynd.com to read more about us, and also click on DyMynd U and you can register there. And thank you again, Mark, for having me. And gentlemen, I really enjoyed your conversation and your insights.
Well, Carolyn, we're glad we can have you on the program and for bringing us an interesting new conversation to talk about. We'll have to bring you back on again down the road, talk a little bit more about how options are spreading out to the female side of the advisor and indeed the client space. And again, listeners, September 19th, if you're going to be in Chicago or if you can make it, if you're in the area, check it out, the Bank of America building here in Chicago, and learn more at DyMynd.com, DyMynd.com. All right, and Aash and Chris, I know you guys are always working on interesting events for the advisors out there, and a lot of interesting content over there at SwanGlobalInvestments.com that the audience may want to check out. So what is on your docket these days over there at Swan, and what events do you have coming up that may interest our audience?
Well, we're still working out the schedule right now, but we're going to have our 10th box events coming up again. That's basically a series of regional due diligence meetings. It's a good opportunity to meet the portfolio managers in a roundtable setting, and then you can discuss challenges and opportunities in today's investment world. And also, it's an intimate setting, again, like I said, to get to know the defined risk strategy and how it can fit inside a portfolio. And like you already mentioned, Mark, we have a slew of research and blog postings on our website that people can check out, learn more about options and where it can fit for you and your portfolio.
Check it out over there, swanglobalinvestments.com. If you want to learn more, there's a resources tab right there. They have the library. They also have, I'm a little bit biased, the Swan on Air, where we have the show up there, so you can get the show there. Maybe some of you are listening to it from there right now, as well as some other great content in their newsletter, The Good, the Bad, and the Ugly. Check it out over there, swanglobalinvestments.com. And of course, our friends over there at the OIC, they're busy traveling the country hither and yon, so I want to make sure I toss over to them as well. If you are indeed an active advisor and you're not checking out optionseducation.org in the advisor tab on the right-hand corner, then you're doing yourself and your clients a disservice. A lot of great studies, a lot of great data. A lot of advisors love hard data. They can sit down with their clients and say, here is the efficacy of using a collar over X period. Here's the efficacy of buying a put or selling a call. They have all that data. They've done all the studies for you. You don't have to do them. So get on over there, log in, get your access to the data. It's great stuff. And I also, mentioned Carolyn's webinar. I'd be remiss if I didn't mention also our friends over there, Eric and the team over there at OIC, also have their own series of an IMCA certificate program coming up. I believe it's later this year. First of its kind in the financial advisor space, will provide financial advisors with the knowledge and confidence they need to serve clients better. And we all know advisors love a little piece of paper they can hang on their wall, a little shingle to say, hey, I am certified in options. Well, they have a certificate now. They can get that from the OIC and IMCA. So check out that over there on the IMCA website or the OIC website, optionseducation.org, if you want to learn more. And last but not least, Mr. Matt, you guys are doing all sorts of interesting things. You mentioned a lot of your back tests over there at ORATS. What are you guys cooking up that our advisors may be interested in, sir?
Yeah, Mark, thanks. It was a great show. Always great to talk to the Swan guys and you, and Carolyn was great. So that was a lot of fun. We're busy here at ORATS. We're moving our back testing platform to the web. So to make it easier for our clients and people to test out option strategies before using them, you could still come to us and work with it. We'll help you run your back tests. I offered out in another show, we do this component volatility analysis that is popular. We've gotten some responses from other shows, so I want to offer that out. You can email me at matt@orats.com, matt@orats.com, and get on that report. And go to orats.com if you want to try out our back tester, Mark.
There you go. A lot of you advisors out there, maybe you have your own strategy and you want to see how it works. Head on over to orats.com. There's a big button there. It's hard to miss. It says try our options back tester. Then you too can see how maybe your 3-month put buy versus 1-month call strategy may work, or whatever crazy concoction you have there. Check it out over there at orats.com and see if it works for your clients. And on behalf of Matt and Carolyn and Aash and Chris and our friends over there at the OIC, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing. And, of course, for sending in such great questions. Keep them coming. We get a ton. We read them all. We don't get a chance to answer them all on the show. Maybe we'll have an all question and answer episode one day, too. We have a lot of questions. Maybe we'll do that, so stay tuned for that. And we'll see you next time for more of The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.